Hey, everybody, welcome to tonight's session with SimpliFunded.com. We are your hard money lender anywhere in the nation. If you are doing a real estate deal and you are looking for funding, then I hope that you will give us a call. SimpliFunded.com. We are again closing on a property tomorrow in Richmond. We're closing in the next couple of weeks with another property in Virginia, but we're working nationwide with individuals who are looking for hard money. So simplyfunded.com. Um, we have a great guests for this evening. These are our Money Mondays where we come in and we talk about ways that you are able to make money with real estate. And today we have Marlene Patton here. Hello, Marlene.
Hello, Cherie. How are you?
I am great. Hope you're doing well.
I am. I'm doing great, and I'm just so glad to be here.
So, tell us a little bit about yourself. And I know tonight's topic, everybody, is passive income for real estate investors. So, I'm super excited to hear some of the content that you have. But before we get into that, how'd you get into real estate?
Well, I have worked in the past as an employee in the real estate space for the last 24 years.
Hmm.
So I was very familiar with a lot of the different types of real estate, primarily commercial real estate.
Hmm.
And the spaces I worked in are like multifamily, commercial real estate and office space and in strip malls, uh, a lot of medical office space, even mobile home parks, affordable housing. I mean, the gambit. So
Hmm.
I really found that to be an area that I started to know very well, and I really dug in. So over the years, I just decided to take that knowledge that I had from working in different institutional settings and start my own firm where I can help others to establish their roots for financial freedom. So it's really exciting, and I through real estate.
Hmm.
I believe it's one of the best conduits to financial freedom, and I just enjoy spreading the word about it.
Great. So, are you coaching people, or what are you doing within your
Well,
company?
what we do is we work in acquisitions to create
Okay.
syndications for multifamily real estate, as well as medical office space. That's our real sweet spot.
Okay.
And we look for opportunities to be able to share that opportunity with other investors who would like to have passive income, like we're going to talk about today.
Hmm.
And we also are involved with development as well. So we're in the middle of a development project right now for affordable housing and a mixed use property. So we're doing quite a few things.
Yeah, it sounds great. So, is this something that a newbie can get involved in, or do you have to have a ton of experience, the things that you're going to be teaching us tonight?
Well, I tried to make it right in the center to be able to talk about passive investing. So this is not for the active investor. These are
Hmm.
things that an active investor should know. But it was this presentation is geared for people who want to make money through real estate, and they wanted to know how to make money through real estate. And really, a lot of the deals that are presented, we have to from the SEC requires us to present the risks that are involved in real estate. But many times the level and of risk it can be a little vague.
Hmm.
So I'm hoping that through there are a lot of books about it. One of the books I really enjoy is called the Commercial Real Estate Advice Encyclopedia. It's by Terry Painter. It's a wonderful book, and it really breaks down all the different types of real estate. But it's more for the active investor. But some of the excerpts you'll see today are from that publication. And there are so many resources out there. So it is not it's for the newbie, it's for the advanced, it's for people who just want to learn about earning money through passive investing. My husband and I decided that we want to make investing our income, and we decided
Hmm.
a long time ago. And it's possible. It's just but knowing that it is a risk and knowing where you are with your area of risk tolerance, which is what I'm going to talk about today. Also, it's important when you're making decisions.
Yeah. The final thing I want to ask you about is the fact that so many experts think that commercial real estate is like going to crumble.
Mhm.
Now, I know that you specifically work with apartment buildings and medical complexes, which is a little bit different than, just your garden variety offices and things like that. But do you have a sense of what's going to be happening in commercial real estate just overall? What are some of the things that you've been hearing and reading and understanding?
Sure. So I think that a lot of the real estate and commercial real estate has had a lot of bumps and bruises recently
Mhm.
because of several factors, COVID being a main one, which had a huge effect on office spaces, um, and a lot of some multifamily. We may see some um, issues in multifamily having to do with the interest rates being going up so high, and that may have negatively affected some who have leverage, who have a lot of leverage on their properties
Mhm.
with adjustable short-term lending, which in turn will cause the mortgage payments to go up higher than what was originally projected in the original numbers that were given to investors and that were used for projecting rates of return.
Mhm.
So that could be something. Uh, we will be seeing a lot of. My personal opinion is that we'll be seeing some cash calls where investors will be asked to go back to the table to help an investment get over a hurdle. Um, but at the end of the day, when you, I don't believe that commercial real estate is going to crumble because where would we go shopping? We can shop online, but in general, there's some things that we just need to go and get. If
Yeah, like I was thinking like deodorant and things like that.
you're
I
right.
was I'm like, I've got to have my Target nearby. So
Exactly, exactly. And not only that, Target's got a 25-year lease with I mean,
Mhm.
they are a one of those tried and true commercial A-rated leases. So whoever owns that property and is
Mhm.
whoever's getting the passive income off of that property, and not from not managing it but letting someone else manage it, they're still going to make money.
Yeah, I mean,
So
what I've been
it's on the
hearing
asset class.
is
I
like
mean,
there are some places in New York that were hyper inflated, some places in San Francisco due to the crime is what I'm hearing. A lot of companies are pulling out there, but like your regular garden variety, self-storage spaces all over the country, small little places. It doesn't seem when I'm reading the articles that those are the things that are going to get hit. It's just like they always talk about New York, San Francisco, and those couple of issues. So,
yeah. So people are running from some places because of different issues having to do with the uh, the friendliness, or I don't know if I want to use that word, but the
you don't have to be PC with us.
incentives that an area will give
Mhm.
to to a landowner or to a landlord.
Mhm.
It's much more, if you're if the state has a lot of restrictions on the amounts of money that landlords can charge for rentals, with from their perspective, it's helping to eliminate homelessness and the hyperinflation that you're referring to. It does have a negative effect on an investor that buys a property at a premium, expecting to be able to increase rents based on the market.
Yeah.
And then if they're restricted there, there's a larger um, a larger factor that a larger ripple effect, and
Mhm.
that is that the person who is projecting these things is not just projecting it normally for themselves; it's also for their investors and their partners, who are expecting to get certain amount of appreciation based off of the net operating income. So I
Right.
mean, all those things, so it's like, why would a person buy in a place where they know that their property is not going to appreciate because they can't increase the rents, because that's where commercial real estate appreciation, one of the areas that is is considered, where the property's value is considered in its rates, rental rates, and the net operating income. So all they can do is reduce expenses, and how much more can you do that if you have to keep up your property?
You
So
can't. Yeah. Yeah. I mean, so it'll be interesting to see what happens over the next few years. I work for a real estate company, and one of the brokers said this morning that he has been calling around different landlords to ask them, what they're buying. And he found somebody who's like, yeah, I've got 5 things I need to sell.
mm,
So, just having people even think about, talking to people, calling people, a phone call is better than an email or a text if they don't know you. But calling them and asking, hey, what are you buying? So we start off with, and then, are you selling anything? And you never know, you might get something that's off market that they just need to unload.
absolutely.
So it's going to be a great opportunity. Well, I do want to go into your presentation here, and you're going to talk to us about passive income. Super excited to hear about that.
Yes, and it's passive income specifically from real estate. I just want to make sure that there are other types of passive income that one can have, but this is specifically regarding real estate. Yeah, so I'll just jump right in here. First, I need to just say this quick disclaimer that the material here is provided for informational purposes only and should not be construed as an investment advice or offer solicitation to buy or sell securities. The material is not intended to be used as a general guide to investing or as a source of any specific investment recommendations, and makes no implied express recommendations concerning the manner in which any individual should or would be handled, as appropriate investment strategies depend upon an individual's abilities and I can't read that below it, and capability, I think it says, and objectives, there we are, for investing. So now, basically, passive income is income that you get without actively participating in it. So to give you just a juxtaposition, if we were looking at being having a property manager for a rental property, where the property is earning rental income, and if I had a property manager managing that property and I just collected a check every month, that would be passive income. However, if I bought a rental and I decided that I was going to fix and flip it, and I bought a rusty old property and I decided to put all new fixtures in it and sell it for some kind of a good upside, that would not be passive income because I'm actively working in it. And I think most of your listeners would know. So one of the things, Sheree, I want to talk about today is risk tolerance. And again, I'm not an investment advisor, so I think you should always contact your CPA, your investment advisor, and your attorneys when you're going to look into, making different types of investments. But one of some of the questions that I would ask myself when I look into whether I have the stomach for an investment is, especially in real estate, is what do I know about it? How much do I know about it? And there are some areas in real estate that I've not worked in, so I generally have to, learn more about it before I decide I'm going to invest. I'll give you an example. Self-storage is a great industry, and I've been reading some about it, but I would not say I'm an expert on it. And before I put one dime into it, I really want to know the ins and outs of how self-storage works. Not enough to own one, but I mean to run one, but enough to say that when I send my little dollar soldiers out to to come back with the spoils, that they won't get slaughtered. Also, another thing that I wanted to, I usually ask myself is, and this is for everyone, is, how much money do I have over my basic financial needs and my emergency fund to invest? Now, with real estate, you may run into a situation, if it's not like a crowd fund, where there may be minimum investments and also requirements to be accredited or sophisticated investors, which would prohibit someone who is not in a financial position, meaning that you don't have a certain amount of money over your basic needs, to be able to, or what the basic needs are as described by the SEC, I'll just say. Um, but you know, if you don't have that, then you know, many times you will be precluded from investing in these types of real estate investments. But there are crowd funds where you can invest up to like $1,000 in these types of investments. But you really need to know if you need that $1,000 and you're going to be stressed out because you don't have that $1,000. Is, you know, you have to ask yourself if this is really the right thing for you to do. It might be just better to, you know, one would say to save that $1,000 until it replicates itself, or whether, you know, so that you can, um, you know, be more confident in investing. Uh,
Or one of the things I say to people is invest in your own skills as well. So if that $1,000 can go to continuing education in real estate, then definitely that's an option as well.
that's absolutely wonderful. That's really true. Because that would probably go much further than, you know,
Yeah,
a
you do a
yeah,
lot with $1,000 in continuing education in real estate. So
absolutely,
actually, you
absolutely,
could probably also get your real estate license if you chose to become a
100%.
realtor.
And then you can make more money as a realtor. Absolutely,
You can make active income as a realtor, and you'd get access to the MLS and all of that stuff. So yeah.
absolutely, absolutely. And where would you be on some of these larger investments as far as your position? You know, if you look at an investment, if it costs, you know, $30 million and you invested $1,000, how much of that investment do you really own? And that's something that, you know, is not always kind of mentioned when it's being advertised, but you have a very minuscule portion of that investment, which would have an effect on your return. So, I mean, just something to consider and ask the operator who is running the investment. Um, Also, what kind of returns do you want to receive? Like, what am I looking for? I mean, some people have very modest expectations, and some people have, you know, expectations that are through the moon. And you know, you got to figure out where you want it to be, and then once you look at these investments and scale them out yourself, which is why having a good CPA or knowing how to run some basic calculations is important, because maybe it's not giving you what you want, or what you it's not projected even to give you what's going to make a difference. And the bottom line is, once you put your money into an investment, that money's going to be out of your ability to use it anymore for a certain period of time. It's going to be worth less every day that is not being you know, every day period. So you've got the time value of money at play that is not in our favor when money is off to the races, unless there are other factors that make that time value of money that you're losing, you know, it compensates for it perhaps on the appreciation of the asset. So I'll get into that a little bit more, but there are a lot of considerations, because your money is not going to be, you're not going to be liquid when you make an investment. It's going to be at work. Um, and the last question is, what stage am I in my life? I mean, am I at young where I can, you know, have more earning years, or am I at a stage where I have fewer earning years, which makes a bigger, you know, decision factor in whether you are willing to risk your hard-earned money. Before I move on, Sheree, did you want to touch on any points before I move along?
No, I think these are all valid. And, definitely people want to think about where am I now? Where do I want to be? And thinking about everything is risk reward as well, like you said. So I would say that uh, there are people on social media who try to sell you the field of dreams.
Mm,
Um, and one of the best things that I can suggest is to work with a mentor,
mm,
um, and even if you have to split your first couple of deals 50-50 with somebody who knows what they're doing, it's better for you to do that than to lose all of your money, or more than you need to, because you have jumped in not knowing how to do this.
that's great advice, Sheree. Great advice. Great advice. And everybody has to, you know, crawl before they can walk. So that's excellent. it's better to have 50% of something than 100% of nothing. So absolutely agree with that.
Yeah, absolutely.
So in basic terms, when, like, again, I'm not an investment advisor, but looking at risk, the higher risk investments are going to normally have higher potential returns, which is really where we saw in I'd say the last 5, maybe not last year, but prior to last year, we saw a lot of highly leveraged multifamily, and that is kind of where we may see blood in the water, in the coming months and years, where things were where leverage was higher than 80%, 85% high, higher, so much so that when the change in interest rates took place, it has the potential to hurt a lot of investments, multifamily investments, where we may see people, and the signs are kind of they're in the stratosphere now, that people are looking to go ahead and sell without losing investors' money and things like that. But those higher risk investments are going to have the higher returns, because it's just the nature of them. And so if you're at a point in your life where you feel like you can be more aggressive because you can recover in other ways, or you have time to recover, then that might be something that is up your alley. So of course, moderate risk is falls in between those two. And of course, low risk is, your T-bills and your CDs that have, zero, very, very little risk. But they also have lower returns as well. And if we're talking about real estate, I'm going to go through the different types of risk based on some of the excellent book I was telling you about, the Encyclopedia of Commercial Real Estate Advice. They break it down pretty well. So, another thing to think about is, when will I get my money back? If you have a short-term hold, which is hard to come by, usually if you're, an investor in some kind of, investment where another person is doing some kind of flipping and you're not doing it, but you're investing in some type of a real estate investment where another person is operating the investment. It's short term for the IRS, under 1 year and under. But as far as the real estate investment lingo that I've been seeing, it's considering a short term hold if it's under 2 years, medium between 2 and 5, and long term when it's over 5. But the IRS has different regulations for and categorizations for long and short term. I want to make that distinction. But the question here is, when will I get my money back? So that's the most important thing that I wanted to stress here, is knowing when you're doing a passive investment that your money's going to be away. You're like, you packing up your kid to go to camp for 2 weeks. Your money's getting packed up and going away for a while, and you have to make sure that
You can't get it back. You can't say, "Oh, I need it."
Right.
Right now.
Some
Yeah.
people will let you out, but it's really hard. It's really hard. And what are you doing to that? That establishment, that operator? You're putting them in a jam.
Yeah, and I've seen contracts where they will give you a hit. They'll say either you don't earn any of the interest you've made along the way, or they may even charge you a fee in order to get your money out. So
Right.
yeah,
And sometimes it's just a matter of someone taking your place, in the investment. If they find someone who can take your place, then you can get out. I mean, but it's really not easy, and it's an inconvenience on everybody involved. So, if it's, but life happens. It's not like, you're a bad person because, you had a life event, but it's just, knowing that if this money is potentially in your mind you're going to need it, it's just know that you may want to hold off or do something that is more liquid. So let's go into it. This is like a real I don't know if this came through as quick as I might be missing a couple things off the bottom, but hopefully it can be read. I wanted to go through this chart, because this really breaks down, if we're talking about commercial real estate, how each of these types of properties in commercial fall into different categories. And this is really according to the Commercial Real Estate Advice book by Terry Painter. And I really like the way he pulls these things out and puts them into categories, because they can really let us know when we're investing in these things where the risk factors are. So extremely low risk, we talked about this a little bit earlier, was like Target. That's your national credit, A+ credit, triple net lease. And triple net lease means that the owner of the property pretty much pays for nothing. The person who's renting the property is paying for the taxes, they're paying for, any of the operating expenses that are happening on the property, and they're paying their rent as well. I mean, the tenant is paying for everything. So you, as the property owner, you just collect money for owning the property. And the other thing that's really low risk about this type of investment is that the leases are very long. So a Target or a Rite Aid or CVS is going to have a 25-year lease, typically. So for the next 25 years, you're going to have, this rent from this renter who is unlikely to default. And that's the reason why when these big anchor stores go out of business is such a brouhaha, because they are the ones that are the seemingly low risk investments. Then your very low risk is your Class A and your Class B multifamily. And this is normally because these are people who usually have savings, and their credit rating is higher. They will pay their rent because that paying bills are part of their DNA. They just do it. They've made it part of their DNA, and so that is why it's considered a very low risk. Now, moving on to low risk, it's interesting. You have mobile home parks on there, and that is mostly because mobile home parks are filled with homeowners. They own their mobile home, and if your mobile home owner doesn't pay for their place in the mobile home park, you, as the owner of that mobile home park, can put a lien on their property. So you have a lot of control there, because you are able to leverage not only the rental income, but also the fact that you can lien the property that wasn't yours in the first place, and, and that's on your property. Also, if you have homeowners, people will tend to, take care of their property, so that does help. And then your senior living, that is, goes without saying. Your seniors are those, either if they're getting assistance or if they have saved their money, they usually have a steady source of income at that point when they make the move to shift over from owning a single family, selling it, and then moving into senior housing. A Class C multifamily, that is considered low risk because those are ones that a person can come in and do a value add, which means that you will come in and do some kind of a upgrade to the property. They're always being upgraded when there's a sale and change of ownership. And that property can now, have a new face on it and has, shiny new, refrigerators or something like that. And it's always filled with people because it's the moderate rental rate charged in the area. So if people don't want to live in a low income property, or they can't really afford a Class A or Class B, Class C is always, is generally going to stay full. And that was the asset class during COVID that didn't get affected as much in multifamily. And then, of course, your medical office space, that is, except for dental tends to not do well in a recession because people can always wait to get their, dental work done. I guess that's not a good idea, but
Which I was shocked. My dentist said that so many people waited after the pandemic to get their dental work done. So,
Yeah.
but now he is booked. I mean, he is so booked. It's
Oh yeah.
ridiculous.
It just takes its time to wait it out, but other things like cardiologists and oncologists and those kind of specialists, they're gonna have people, the outpatient surgery centers, those are gonna be there, and they're gonna have people.
Yeah, I mean, plastic surgery and OBGYN, definitely.
Oh yeah, oh yeah. Now, of course, during COVID, that was definitely something we didn't expect to have because elective surgeries weren't allowed, for a while. But I'm sure, like you said, as soon as the recession or the pandemic rules subsided, they're back to being booked. So those are the things you want to look at, like are these things that I go to all the time, and not that the people I know always frequent these places, and that can give you a better idea that this is something that is a good investment. And then industrial property, and industrial property, that I love it so much. I'm not an investor in it, but I really love the concept because we have to think about how many things we get from an industrial site that you have to have, and they're usually not the prettiest things, but the people who work there have a lot of pride in their workmanship and their workplaces, and it's necessary and it's needed, and in a lot of places there's not as much of it. So I do know people who only invest in industrial office space. So let's go into moderately low risk. So student housing is this is moderately low risk because if your property is near a school, you're going to have students, but of course your accounting for your income has to be looked at a little bit differently than a regular multifamily, because you have it's seasonal based on school and school, and you also have sometimes you can have more damage to your property because of parties and stuff like that. So the little things to think about that are different. But the great thing about student housing is that you charge by the person, by the head in the bed versus the whole lease. So that's a really great thing, because you don't have to have a completely vacant apartment. You can just have 2 rooms that aren't occupied in a 4-room apartment. So it really is a different way of thinking of it. Storage facilities, of course, we always keep having stuff and more stuff and more stuff, and we keep adding to our stuff. And then Amazon tells you to buy more stuff, and you buy more stuff. So we always need a place for our stuff. So that's something that is, a lot of self-storage facilities are being targeted now as great investment opportunities. And I've seen that wave of these small mom and pop storage facilities being bought out. By those who are trying to amass a large number of self-storage facilities. You can get so many of them in one small place, and you can charge rent, up to $350 in some metro areas for a 10 by 10 space. I mean, it's
That's
great.
a lot of money. So I live in rural America, and I actually passed some land that somebody bought, and they put trailers on the land, and they had a sign up saying self-storage. So people are getting very creative with their
Absolutely.
self-storage right now. I don't know if I feel that's moderate risk though. Moderately low. I mean, people have their stuff and they want it. So,
Absolutely.
mhm.
Absolutely. I mean, I find it interesting, the strategy that I learned about years ago was buying a plot of land and putting a storage facility on it and waiting for the path of progress to get to that area. So if you knew, let's say you can look at the county plans, and that roads are going to be widening in that area, that certain things are indicators that the path of progress and development is coming in that direction. But you just put a self-storage there, and then you sell the land because when it's time, because that is a piece of land that's going to increase in value soon. So you're not just sitting there with some land; you also can make money off of it, because people like to store their stuff. So, where would you put this self storage facility on the if you were looking at the risks, Shireen?
Well, I guess this should be moderately low. I think it obviously it depends on where it's located because some places are very desirable. But like I said, I live in rural America, and I just we have a lot of land here, so I guess people don't need storage facilities as much. But yeah, I just see so many people wanting to buy storage facilities as well, and you only need one person manning it,
Yes.
so yeah, it's one of those things where I think if you're building it, obviously, you have a certain amount of costs that have to go into it. The security being like I think one of the biggest costs, but then once it's built, then it should be a cash machine.
I
Should be.
agree. I agree. And I also agree that location is a big deal as well because a storage facility in New York City or DC is going to be way more in demand
Mm-hmm.
than one, like you said, in rural America. Because if you have the space in your own property, why would you pay somebody? You can just buy
Yeah.
it. You
Yeah,
know,
exactly, exactly. But even in rural America, we have them
you
here.
have your
So
storage. People like their
mm,
stuff. They like their stuff. And it's just interesting. You can have a storage facility and people never go back and see it. They just keep paying for it every month.
mhm.
And you can ask what's in there. Oh, I don't know. It's a bunch of my stuff. It's like, are you going to use that stuff? Well, and you go back into it. You've had it in there for 10 years, and
Yeah, people have their stuff in there for 10 years and not, and not move it.
if you
So
need it, obviously not if you haven't got in there for 10 years. But
yeah,
it's the
yeah,
way of our minds. We don't want to get rid of stuff. A lot of times they're
yeah.
sentimental and things like that. But yeah, I really think that it's a wonderful thing when you're looking at a major metro area.
Mhm.
And they are in high demand. A lot of people want to get their hands on one, especially a mom and pop one that's been running for a very long time.
Yes. So tell us about the other categories.
Okay, so we've got our moderate risk and that's your class C minus, and those are going to be. And I didn't really put D on there because that's kind of like your war zones and things like that. But your class C minus is going to be where you may have a lot of subsidized, and not the subsidies make it class C minus, but you may have a higher amount of deferred maintenance in the property. And you may have also perhaps it not being near uh, community serving, retail establishments like grocery stores and things like that, which make it a
You're
more.
trying to say good? You might as well just say the hood and you're trying to be diplomatic, but
Well, I mean, there's the hood, and then there is, an area that is underserved.
underserved.
They're
Okay.
very different. Like
So
a
so
war zone
C,
is a class D where,
yeah.
you got to come in with armed guards to be able to get out of there. I mean, it's different.
Mhm.
Underserved is just they just don't have the facilities.
But is
And
that a C minus that is underserved? I guess is there a C? Is there a
yeah,
class C?
there's a class C, and that's in the low risk because
Okay.
that one is going to be filled more because that's the
Oh,
majority
I see it there. Okay. Yeah,
population. But it becomes C minus when you have a lot of deferred maintenance and you
I
have,
got it.
you may have higher delinquencies. You
Mhm.
may have, because there are not opportunities for employment. It just has some inherent problems.
Yeah. So I mean, it's like more risk, more reward, but the question is how much risk do you actually want? I
Ex-
know people who only buy in like class C territories. Um, because they like that balance of the risk and the reward for that one. Um,
Absolutely.
I mean, I know people who buy only student housing, or they focus on student housing. I've met a company that did senior housing, and they do Section 8 senior housing. So you can really get specialized
Absolutely.
with a lot of these things.
And and that's a great point, Sheree, because you have to know your specialty. You have to know your niche. And for someone who is just doing class C, they
Mhm.
know that type of asset very, very well, and they will be able to run it better than someone who runs a Class A because
Mhm.
you know uh, they have really studied it.
Yeah,
But if I
and
could
they
just
have the yeah, I'll pull it back up. They have the experience and the operations like down pat. So yeah,
absolutely,
I was trying
absolutely.
to be fancy with us.
I'll run through it quickly. I don't want to sit on these items too long, but this is the kind of the meat of it. And of course, mixed use buildings, and only this is only moderate risk because you have different parts of your building that are different. That are assessed differently and have different revenue streams.
Mhm.
So that that and the mixed use could have your grocer, could have your a dance studio, and those all have different risk factors because of the different types of retail that are there. So that's why it would fall into that category.
Yeah.
Your moderately high risk are going to be your retail centers because they are most affected by recessions.
Mhm.
We saw that. If you look at the 2008 2009 recession, and you also look at COVID, we did see it. We could see retail taking a dive in certain areas because of these factors that if people don't have to spend money outside and they can wait for it, they will.
Yeah. So when
And
you say retail centers, do you mean strip malls as well or just
absolutely. We saw
okay.
strip malls, box malls. They tend to now strip malls will I think fare better because you have your pharmacist there. You have your but if you have a cleaners there,
Mhm.
if you're in a deep recession,
Mhm.
you take your clothes to the
Yeah,
cleaners.
people aren't going to clean, yeah, go to the cleaners. Yeah.
Certain
They
things.
they will go to a bar and
Oh
they will go to Panera, at least in my neighborhood, you
yeah,
know.
right. They'll
Yeah.
go to the grocery store.
And they
That's
go
what
to the
it
grocery
is.
store. Yeah,
Mhm.
absolutely.
Gonna
But the
go to
grocery
your
stores, I mean, they have good rental amounts, but the grocery stores really run on thin margins. So I suggest people, if you're going to play in that field, we're all family here, going to play in that field, then I would be very careful what neighborhoods I bought, that had grocery stores in them because there have been a lot of reports, and the reports are true. I mean, I'm talking to people on the inside.
yeah.
So, with regards to the theft and things like that, and we've had these conversations here. So,
Yeah, there's a lot going on right now with that, and
mhm.
it's very, very unfortunate. It's very, very
Yeah,
unfortunate.
yeah. I mean, and they end up closing.
And who does that help?
So
It helps no one.
doesn't help anybody. Yeah. So, and then the very high risk, the office properties and the hospitality, hotels, motels, things like that.
Absolutely,
Yeah.
because in general, during these are risks during a recession, and I want to actually make that point of clarity because when you look at risk, you want to look at it in the worst case scenarios, to be able to assess if this the worst thing happened, how would I fare. And so we can see from the pandemic, what's happened to office properties, and how a lot of office owners are either pivoting if they can to adapt, changing the use, if it, and that comes with its own issues with zoning and things like that as well. But and hospitality is also one of those things that if you don't have to travel, and during the pandemic, people didn't, and so those are the things that. And but there was one, I believe, Choice Hotels. They did the best out of all of the hotel chains in the Mid Atlantic because they were moderately priced, and people get down to price at the end of the day when it comes down to a recession.
Yeah, I knew a lot more people who were just doing Airbnb during that period of time. So,
Absolutely, that was
but
one of
now you have a lot of cities that are clamping down on Airbnbs. So a lot of cities are outlawing them, or you have to have a special license to have them.
absolutely
So,
taxes, the
yeah.
special taxes.
Yeah, special taxes, you have to have hotel type taxes, etc. So it's not the cash cow that it used to be.
Yeah, everything has its like when I think when everybody zigs, I zag. because when the herd
True.
runs to it, I'm like, oh no, it's already sailed. By the time you hear it on, on the news or something like that, this ship's over. It's done.
Yeah.
You kind of have to see it on the rise.
Mhm.
So I talked about commercial types, but there are other types of commercial real estate other types of real estate that one can invest in and still get passive income. If in single family rentals, if you have a property manager renting out your property, short-term rentals, real estate investment trust, which you can buy on the stock market, a mutual fund in a fund where you have institutional investors like banks that are buying up properties, usually Class A properties, and you have a much lower risk there because they're going to buy the best properties. They're going to have a lot of money behind them so that the properties stay Class A. You can also invest in mortgage notes and mortgage notes funds, which are really have strong returns, as well as depending on the operator of the fund, you can really dig into the risks involved there, because there are many operators of mortgage note funds that really vet the mortgages that they are backing, to be able to know that the person who they're investing in, it really has a track record of paying their loans and having assets that perform. And also land leases are another way. If you have your property managed and you're getting a ground lease off of a property and your property is managed, you're just collecting money as well from the person who is leasing the land on that your property is on. So all of these things have like layers of how to do them and the ways that you can get into it. But I really wanted to do a high level look at the different types of passive income that you can have, because it's so multifaceted and all of it comes with its share of risks. And that's one of the things that I don't see on, like you said, in social media. We just see, everyone running to these investments, but it's good to know it's not, and it's not a bad thing to have a risk. It's everything has a risk, It's just knowing what it is and knowing where you are with it and knowing how to, then you can feel comfortable to move forward toward it. I just also wanted to talk about the types of income to expect. And this is something that everyone should talk to their CPA about, because each of these types of income has its own tax ramifications. So it's definitely something that once you're going into this, you want to say, well, how is this going to affect my overall income, and what are the tax ramifications, especially of appreciation that it can have. Also, the last thing is learn the terms. Learn the terms. If you're going to invest in passive income, learn what a preferred return is. Because if someone says you're not getting preferred returns, just know what that means. There may be other people that get paid before you. And that may not be a bad thing for you, but you just have to understand, what's being said. Understand terms like internal rate of return. What does that mean? Capitalization rates. As they say, it's got a cap rate of 12%. Well, wow, that's huge. And that means that property should be at a value, purchased at a lower cost because they have an inverse relationship. So there's a couple things that you don't have to be an expert. You just gonna have to look up the term online and know what it means and know what it means to you and your money. Know the difference between return on investment and return of investment, because they're two different things, but they both have the same acronym, ROI. So which one are they talking about? Are they returning your original investment value, or is someone giving you money on top of the value that you originally gave to this operator? You learn terms like value add. And if someone says it's a deep value add, that's just industry jargon that there's a whole lot that needs to be done to that property. And it, again, a higher risk. PPM is private placement memorandum. Know that is a very absurdly large document that you have to read. Like one of those things, if you don't really like reading, have somebody, sit with you that will just rub your shoulders while you're doing it. But it's one of those things, if you're going to invest in a real estate deal, you have to read the PPM, because that tells you about all the risks. And if it doesn't say any risks in the PPM, run like you are on fire, because that means that it wasn't properly disclosed. And also net income, and I like to put net income and loss because you really have to look at the financials and know if there have been losses and project, if you do your own testing, if you really want to get into it. But I believe that is all that I wanted to share. I also wanted to just say this, which is just something that I believe is arm yourself with education and take one step forward each day toward your financial freedom. Because that's all you have to do is continue to educate yourself and continue and just take one step forward each
I
day.
love it. I love it. So, everybody give an exclamation point for Marlene. She can see all of your comments in here. I've been saying hello to everybody that's been in here. Um, let's say that somebody does want to start off small. So, they can afford $10,000, $20,000.
Mhm.
And they're thinking about, you know, getting it some sort of passive income in, and I call it semi-active because it's not really ever really passive. um,
True.
but what are some of the things, because we talked the extreme about if you only have $1,000 it's probably best for you to invest in your education. But if you've got 20 grand, 25 grand, what are some of the things that you think that people should consider?
Well, I think that amount of money, again, consult your financial advisor.
Hmm.
But there are opportunities like REITs, real estate investment trusts. I mean, that is a safer place to put your money.
Hmm.
Normally you can look at the historical returns that they've had. You can look at the types of that the investments that those REITs make, and I think that's a great place to start. And then you can really see how these institutional investors put their money towards real estate. If you have an operator that will allow you into an investment for like a syndication with that amount, again, if that $20,000 is not going to be what you're going to use for like your kid's education or something like that, I think it's a great way to start if they will allow you. A lot of times it's too low for a lot of
Yeah.
syndicators to allow you into those investments, and you still would have to be considered one of where they would allow in sophisticated investors if you didn't have $1 million, a net worth. But you still could do it. Now you could also do crowdfunding,
Hmm.
as well. But again, that asking the operator with this $20,000, what's my position going to be in this investment, you know. Another thing that you can do is you can use that if you had a self-directed IRA,
Hmm.
and invest in some kind of a fund, if you're allowed to, for mortgage notes. There many of the things that I listed there, if the minimum investment allowed you to, would
Hmm.
be a decent thing to do. I always look at the time value of money, and see how long the money's going to be locked away. you know um, is there something that I can do that would be a better use of the money for the time that it's not going to be in my possession? Is it better off for me to just get a mutual fund until I get, if I'm expecting more money, or be able to add to it to make it a larger investment? So these are all questions that we have to ask ourselves in our own personal situation. But any of those investments that you can get into, if you're just raring to get in and take your first step, you know, you could do, if
Hmm.
the operator allowed you to at those minimums.
Okay, so we have a couple of comments and questions here. Dr. Virginia is in the building saying great, insightful information to you, Marlene. My takeaways: student housing charged by the head and the bed. Work with a mentor and partner and join funds. You are absolutely correct. And Dr. Virginia, you were part of that student housing thing that we did last year. So that was really good. Mentor Shelley is asking, what are the ROI? So we're talking about return on investment or return of investment on REITs. But let's pretend we're talking about return on investment.
I mean, it all depends on the investments that you're looking at.
Hmm.
They're going to be competitive normally. a little bit more competitive than your regular mutual fund,
Mhm.
because they are backed by real estate. And instead of the stock market, you do have some mutual funds that may do better than REITs. So it really depends on the historical returns that that particular REIT is performing with. So if you go on
Do
like
you check past performance or do you check what they're thinking in the
you
future?
can check past performance, and you can look
Okay.
at like if you go on like your any type of E-Trade, but it's not E-Trade anymore, right? It's something else now.
Oh, yeah, I think they just sold, I know one place that I have
There.
money, like, sold to Charles Schwab or something like that, so
Yeah, but their platform is great because you can
Mhm,
type in, the type of investment you're looking in, and it'll give you, a lot of, them. You could look at, the type of real estate that you and um, like the most. Like, let's say you like multifamily, you can look at REITs that
mhm,
really have a heavy focus on multifamily, or a heavy focus in a different areas, or if you want to diversify and make sure that your REIT diversifies in different areas of real estate, so that, those are all things that you can research, but they do tend to do well,
mhm.
because they have all that institutional money behind them.
Okay. So I know when I was looking at uh, dividend stocks, one of the things I noticed is that the more the yield was, the riskier the stock was.
Right.
So I think it is important to reiterate what Marlene is saying is maybe not just look at the returns, but also look at the mix of properties that they have within the REIT, because you could end up looking at something that has, a gazillion percent, and it's because it has some of the riskiest stuff in there that you really don't want in your portfolio. I think it's a great, I think it would even be great for people just to go and kind of do that as an exercise. And with REITs, it's like buying a regular stock. So
Absolutely.
there are some that are, like we could get in with a couple $100 maybe.
2,500. I mean, but yeah, usually.
$2,500, yeah. So if you've got a self-directed IRA, or Charles Schwab account or something like that, and that's some place you wanna play in, then definitely doing that. So, anything else you wanna tell us? We got 3 minutes left. Anything else you wanna tell us?
Let's see. I just I think this platform is incredible, and I just take my hat off to you, Cherie, because
Mm,
you really provide a wonderful service to the community for
thank you.
just being more educated on these things. And it's just, I just think we just have to not be scared, just be educated and get out there and do it. And Yeah, like I said, my husband and I decided that we wanted to have investment income be our income. So, once you make that decision, then it's like you just become laser focused on making that come to fruition. So,
Well,
and
I love
nothing's easy,
that.
but you just take one step forward every day.
Yeah, I love that. I thank you for being here and kind of sharing that knowledge with us, and just gets us to expand our minds with regards to what's possible. So, ladies and gentlemen, that is our session for the evening. Thank you so much, and I will see you on the next session. Take care.